What is the difference between a trader and an investor? An investor earns money when the price or value of a particular asset increases. On the other hand, the trader profits from the price movement in any of the direction, no matter if it moves up or it moves down. This means the more volatile or the more movement in the market, the better it is for the traders. And the good thing is, crypto markets are currently the most volatile markets, and we got to make a good use of this opportunity. Hello everyone, what's up? I hope you are doing well. My name is Daksh and today I'm going to be your instructor for this course. For those who don't know me, I am a full-time trader and investor. I am the founder of Cryptos Monopoly, Forex Monopoly and Investors Monopoly, and I am also one of the Binance top traders. As just in 2021, I was able to gain over 30% and successfully flip a couple of accounts. Now, just like any other market, the crypto market has its own sets of distinctions, logic, platforms and methodologies, and also different strategies need to be used. So today I'm going to teach you everything you need to know about crypto trading and also help you master the #1 crypto trading platform, Binance. Welcome to Crypto Trading Masterclass. This course is meant to take you from having no knowledge of cryptocurrency trading to being a profitable professional crypto trader. It makes no difference if you have no prior knowledge of cryptocurrency or have never ever traded anything in crypto. This course contains a full foundation module designed to assist students in mastering cryptocurrency trading and its platform. In this course, you will learn complete foundation of cryptocurrency trading designed to assist students in mastering cryptocurrency trading, mastering the world's #1 crypto trading platform Binance, how to read the crypto market like a professional trader, execute crypto trades with different types of orders, a proper take profit plan to help you collect maximum profit in crypto trading, and not only that, but I'm going to share 3 strategies that I have been implementing which have given me incredible results, and also my own risk management plan for this strategy. So thanks for watching. See you inside.
Hello and welcome to this video. In this video, I will tell you how to open a Binance Futures account in 3 easy steps. Opening a Binance Futures account is super easy. To open a Binance Futures account, the first step is to log in into Binance from your laptop or your smartphone. And if you don't have an account over here, you will first have to create one. The second step is to go to the derivatives and click on USDT-M futures. Now to the right over here, you will have an option to open Binance Futures account. Click on that and your account will be opened. Now sometimes when you open a Binance Futures account, they do ask you to solve a quiz. And this is to make sure that the user knows what Binance Futures is all about. So after you are done opening an account, transfer funds and you can start trading. We will learn about that in the next video. Thank you so much for watching. Hey guys, welcome to this video. In the previous video, I showed you how to open the Binance Futures account. And in this video, I will tell you how to deposit money into your Binance Futures wallet for leverage trading. For depositing funds into your Binance Futures wallet, you will first need to add funds to your spot wallet. Now you can add Bitcoin to your spot wallet and then convert it into USDT, because in futures account you will need USDT. So when you have USDT, go to the fiat and spot section. Here click on transfer, choose USDT-M futures and here select USDT. Enter the amount and then click on confirm. The USDT will be transferred to your futures account instantly. Now if you wish to see it, just go to the derivatives, USDT-M futures, and your balance will be visible over here. Now if you wish to transfer some amount back to spot wallet from the USDT futures wallet, all you have to do is go to the transfer option and from here you can transfer it back to the spot wallet. I hope you enjoyed this video. Thank you. See you in the next one. Hello and welcome to this video. In this video, I will tell you how to set the chart in the Binance Futures Trading platform. Let's quickly jump to the platform. This is a Binance Futures Trading platform that does look a little complex to most beginner traders. But I promise you, it will be much easier when we customize it. So make sure you watch this video till the end. Now, there are a lot of unnecessary tools which you may never need while trading. So first, let us sort the tools and remove the ones which we don't need. For that, click on the settings option over here. Here Binance provides you with two different themes, light and dark. I prefer using the dark theme, so I have set it to dark. Now in the color setting, you can choose any between these two. These are not typical colors for your candlesticks, and we can use many more different colors, and I will tell you about that later in this video. Now moving forward, in the layout section, we have two options, the Pro mode and multiple chart mode. Multiple chart mode is mostly used for correlation and by scalpers, like when you need to look at several different charts at once. You can click on this, and then from here you can set different pairs to a different window. I do not need it, so I always choose the order mode, that is the Pro chart. Now over here you will need this quick order tool that will allow you to directly buy and sell from the chart itself. This option is for the favorite pairs, like if you target only a few pairs, then you can make it favorite from here by clicking on the start, and then when you select the favorite option from here, your charts will be visible on the top and you can anytime switch between your favorite charts. This will save you a lot of time and most importantly help you stay focused on the charts you have analyzed. Now you won't need the market watch list to appear on the chart, and it takes a lot of space and is useless. So turn it off from here. Now you will need the chart. Now the next thing is the depth. The depth will bring the depth of market chart to the front, but I don't want it to be on the front as I can use the depth chart from here itself. So I turn it off. Now there is not much use of orders and trades option, so I will just switch it off. Now we have removed all the unnecessary tools. So now let's adjust the chart from here so that it looks big and clear. Now Binance provides you with three different charts. The normal one, which is provided by the Binance itself, the trading view chart, which I like the most, and the depth of market chart, which is used to study the supply and demand blocks. The trading view chart offers a large variety of tools and indicators, so I will recommend you to always use that. Now a quick overview of the chart. So to the left we have our tools required for technical analysis. Here we have the time frame section. From here you can add the technical indicators, and from here you can watch your positions and live trades on the chart itself. From here you can select the currency pair, and the details are given over here in this box. Now if you are a day trader and also a swing trader, like it may happen that sometimes you are long on some pair as you were swing trading, but you want to short the same pair for small day trades. So you cannot do this in the normal mode. So for that, click on the three dots over here, go to preference, and now go to position mode and click on hedge mode. By doing this, now you can go both long and short on the same pair whenever you want. The next thing is setting a proper toolbar. Here you have a lot of tools, but only a handful of them are useful. So what you can do is create a favorite toolbar and add the tools which you use the most, so that when you trade you won't always have to go through the long process of going over here and then selecting it. Like I need only a handful of tools for my analysis, like the cross, the Fibonacci retracement, the vertical line, the horizontal line, the rectangle, and some positioning tools. So to add the tools to your favorite bar, just go over here and star mark the tools you need. And if you don't have the favorite toolbar, just right click on the chart, go to drawing tools and select the favorite toolbar option. Now the most important thing is setting up a clear chart and using the colors you like. For that, right click and go to properties. From here you can select the type of chart like candlestick, line charts, bar charts, etc. Now from here you can change the color of the candlestick, the borders and the wicks as per your needs, and from here you can set the color of the price line. Now keep the scale section as it is. Now in the background section, keep the background color as you need, and I have kept it as black. Now you don't need the vertical and horizontal grids in the crypto trading, so just remove them. For that, what you can do is change the color of the grid lines to that of the background so that they can merge. Now go to the time zone section and select the time zone as per your needs. Like I live in India, so I'm keeping it to Kolkata. Now click on OK and the changes will be done. And that's it. You are done with setting up the chart, and look how cool and beautiful it looks. I hope you understood everything correctly. See you in the next video. Hey guys, welcome to Crypto Trading Masterclass. In this video, I will tell you what is funding rate, how to calculate it, and how can it affect your trading account. But before we start, there is a very important thing which I want to talk to you about. I have seen many traders don't give much importance to the funding fees, or let us say calculating the commissions. But in a long term, it can cost you a lot of dollars, and it is very, very important. So we will learn about that at the end. Just make sure you watch this video till the end. What is funding rate? After every 8 hours, the broker charges the trader a small amount of fee that is deducted directly from his account, and that fee is called the funding fee. To understand what is a funding fee and why are we charged with it, we will have to first understand the different types of future contracts. There are two different types of the futures contract: the traditional future contract and the perpetual futures contract. The main difference between both is that the traditional futures contract has an expiration time. That means if a trader holds a position until the end or until the time of expiration, his position will be forcefully closed and the outcome of the trade will be settled. Normally, people trade on traditional future contract, but in cryptocurrencies, we trade on perpetual futures contract. And in a perpetual future contract, there is no expiry date, which means that if you open a trade on Bitcoin today, you can hold it as long as you want until your account liquidates. Now, for this to happen, the broker has to maintain or converge the difference between the spot rate and the futures rate. And so a funding fee is charged from or paid to a trader with an open position. Now, if you see the Binance trading platform, you will notice that the funding rate is displayed along with a timer beside it. That timer tells us after how many hours or minutes the funding rate will be charged. Like here, it shows the funding rate is 0.0157% and the countdown is 6 hours. This means that if you have an open position on this pair, you will be charged with a funding fee of 0.0157% after 6 hours. So now, if a funding fee is charged, whom does it goes to and what determines it? Unlike Forex and stockbrokers, here in the cryptocurrencies market, the funding rate is peer-to-peer. That means it does not go to the broker and is directly exchanged between the buyers and the sellers. That is, when the funding rate is positive, the traders who are long pay for the short positions, and conversely, a negative funding rate indicates that short positions pay for longs. In perpetual futures trading, the funding rate consists of the interest rate and the premium rate. The interest rate is mostly fixed with all the brokers, which is around 0.03% a day. But the premium rate changes as per the volatility in the market and the difference between the spot price and the futures price. Now, let us see how to calculate how much amount will you get charged with. The amount you will get charged depends upon the position size. For example, let us say you bought one Bitcoin at a price of $10,000 and the funding rate was 0.015%. In this case, you will be charged with $1.50. Again, if you bought 5 Bitcoins at a price of $10,000 and the funding rate was 0.015%, in this case, you will be charged with $7.50, as 5 Bitcoin at the price of $10,000 is equal to $50,000 and 0.015% of $50,000 is $7.50. You can clearly see that as your position size increases, the amount you are charged with increases as well. Therefore, it is very critical for a trader to understand how funding rates can greatly affect the trading account. Now, normally whenever a trader with high leverage enters a position, he doesn't pay much attention to the funding rate he will be charged with and calculates a position size without including the funding rate. The problem with this is many times when the funding rate is high amounts get deducted from the account which the trader fails to notice. And as a result of this, the liquidation price of the trade narrows and there is a high chance of liquidation of the account. Sometimes the funding rate also appears to be a blessing. When a trader is paid with a funding rate and if the trader is using high leverage, he can get profited with that funding rate without even actually winning the trade with a high margin. And many traders use a strategy for this and get benefited from the funding rate. I hope you enjoyed this video. If you have any doubts, send me a direct message and I will be happy to help you. Thank you so much for watching this video. See you in the next video.
Hello and welcome back. In this video, we are going to talk about two very important things that the Binance futures trading platform offer. And those things are leverage and margin. Like if you go to the Binance trading platform right now, To the right over here, you will see that there is two boxes. On one it is written cross, and on other it is written 20x. So those are nothing but the options for choosing the margin and the leverage. So let us understand each one step by step. So the first one is leverage. Like, what the hell is leverage? Leverage is nothing but the money which we borrow from the broker. It is like, let us say that you have a $1,000 in an account. So with that, you will only be able to buy cryptocurrencies worth of $1,000, right? With $1,000, you will only be able to buy or sell cryptocurrencies worth of that much amount. But from here, if you go and choose 10x, that means that you will be able to buy or sell 10x the amount of money you have in your account. Like, you have $1,000, so you can, if the leverage is set to 10x, then you can buy and sell cryptocurrencies worth of 10,000 US dollars. And if you move it to 20x, then it will be of 20 times than your account balance. And the maximum it offers with BTC US dollar is 125x. That is, you can use 125x more money than you have in your account. And this is how, like, people make that much amount of money while trading, because they use a lot of leverage. But using a lot of leverage is not good. Like, it is a double-edged sword. It can go in your favor and it can also go against you. So it is always advised to keep the leverage to 20x or maximum of 50x. But in my opinion, the crypto market is very, very volatile, so 20x would be a good amount of leverage to use. So that was what leverage is. Now the second thing over here is, here you can see a box with cross. Like, it is written cross, and if you click on it, you will see that they offer, like the Binance trading platform offer us with two different types of margin mode. The first one is cross and the second one is isolated. So let us understand each one. So if you read over here, it says that in cross margin mode, all cross positions under the same margin asset share the same asset cross margin balance. In the event of liquidation, your asset's full margin balance along with any remaining open positions under the asset may be forfeited. And the second one is isolated margin mode, in which they say manage your risk on individual positions by restricting the amount of margin allocated for each. If the margin ratio of a position reached 100%, the position will be liquidated and margin can be added or removed to your position using this mode. So what they're trying to say over here is, there are two different types of mode. The first one is cross and the second one is isolated. In cross mode, like if the margin is set to cross mode, your total account balance will be used as a margin. Like, let us say that you have $1,000 in your account and you opened a position worth of $10,000 with the help of 10x leverage, right? So if the position goes below, like, if you get a loss of 10%, which will be equal to $10,000, then all of your positions will be liquidated. That means that your total account balance will share, like your total positions will share the total account balance you have. But with the isolated margin mode, what they're trying to say is, you can now allocate a different margin with different positions. Like, let us say I have a $1,000 account and I try to open 3 to 4 different positions on different pairs. Like, I opened one on BTC USDT, then I opened one on Ethereum, then on ADA, and then let's say on XRP. So I can set different margins to each of my trade. And when that margin is hit, like when we have a loss which is equivalent to the margin we allocated, the position will get closed or the position will get liquidated. So this is what the margin mode in Binance platform means, and cross and the isolated are the two different types of margins which they offer us. And in my opinion, it is always better to use cross, because we will anyways be using stop loss and take profit, so it won't matter to us like what we do. So it's better to use a cross margin mode where our whole account balance is being distributed between different positions. So this was it. This is what leverage and margin means. See you in the next video.
Hello and welcome to this video. In this video, I'm going to tell you how to open a buy and sell trade in the Binance trading platform. And there are two different ways to do it. So make sure you watch this video all the way to the end so that you don't miss out on any of the steps. Now let's get right into this. So this is the Binance futures trading platform, and there are two different ways to open a buy and sell trade in this platform. Now let us go through each one step by step. So the first one is, if you want to open a market order, that is an instant order execution, then you can do that from this tool which comes in handy when you are using market execution orders. For those who don't have this on your screen or on your chart, what you can do is you can just click on the quick trading option. When you do that, you will get this tool on your chart. Now to open a buy or sell trade, enter the position size over here. Like let us say I want to open or I want to buy 2 ADA. So I will put the size over here, and then if I want to open a buy trade, then I will click on open long, and if I want to open a sell trade, then I will click on open short. So let's say I want to open a long or a buy trade. So as I do that, you can see that my trade is instantly opened at the market price. Now there is another way to open a trade. Now for those who use a different types of limit orders and all, what they can do is they can go to this section over here, and now there are 3 different types of orders which the Binance provides. The first one is limit order, which tells us that if you want to open or sell at a particular price, you can select the limit order, and when the price reaches that level, your trade will be automatically opened. So in that case, what you have to do is just enter the limit price over here, and then amount of ADA or whatever currency pair you want to buy or sell, and then click on buy if you want to buy and click on sell if you want to sell. And then from here you can also select the TP and SL, that is take profit and stop loss, and here TIF means the time till which this order will be valid. So GTC means good till cancelled, that is until and unless you cancel it, the order will stay intact. Now there is also a market order like we did over here. The steps are the same. Just enter the amount of ADA or the currency you want to buy or sell, and then click on buy if you open long if you want to buy, and then click on sell or open short if you want to sell. Now there is another option here which is stop limit order, and the procedure for this is the same. So this is how you open a buy and sell trade in the Binance trading platform. And after you do it, like after you open the trades, all your trades will be visible over here, and then you can close all your positions from here itself. So you can enter or open a trade from here and this box, and you can close it from here by clicking on close all positions. Or let us say if you have a couple of entries, then you can just click on this option over here, and your trade will be closed at the market price. So that is all for this video. See you in the next one.
Hey guys, welcome to this video. In this video, I will tell you how to set take profit and stop loss in Binance futures trading platform. Now, for those who don't know what stop loss and take profit is, here is a brief of it. A take profit is a limit order in which the trader sets a limit order at the predetermined level, and when the trades are in profit and move to that level, the trade automatically gets closed. Similarly, a stop loss is a limit order used to limit the loss, and in this a trader sets a limit order at a predetermined level, and when the trade is in loss and moves to that level, the trade gets closed, restricting future losses. For example, imagine you entered a buy trade at this level, which is $1, and you think that the price may move to $1.20 and you need to book your profit here. So you cannot always keep looking at the chart, but you can set a take profit at $1.20, and when the price comes to this level, the trade will get closed in profit automatically. Now again, imagine you entered a sell trade at this level, which is $1, and you want to restrict the loss for that. So you can use a stop loss limit and set it wherever you want. Let us say you set a stop loss order at $1.20, and so when the price moves up till this level, your trade will automatically get closed with a loss. I hope you understood what take profit and stop loss is. Now let's see how to use it on the Binance platform. To set the take profit and stop loss on Binance desktop version, just go to your live position section, and to set stop loss, enter the level at which you want to exit in loss over here, and then click on confirm. The take profit and stop loss will be set, and those order will be visible over here in the open order section. Now for those who use Binance on the smartphone, to set take profit and stop loss, go to position section. Here click on take profit and stop loss. Now enter the take profit and stop loss over here, and then click on confirm. Your take profit and stop loss will be set. Now always remember one thing, while you set take profit and stop loss, always use mark price. So after you set take profit and stop loss, it will be visible over here in the open order section, and you can modify or delete the order from here itself. I hope you understood how to set take profit and stop loss. Thank you so much. See you in the next video. In the previous video, we learned about the different types of orders we get to use in crypto trading. Now, in this video, I will tell you what is buy limit and sell limit and how to use it on the Binance trading platform. Buy limit and sell limit falls under the limit order category, and I have explained that in previous video. But now a buy limit is a type of order in which you order your broker that you want to open a buy trade when the price reaches your desired or mentioned price, and a sell limit is a type of order in which you order your broker to open a sell trade when the price reaches your desired or mentioned level. There is an important thing to note, that is, to enter a buy limit, the current price should be above your desired level, and to enter a sell limit, the current price should be below your desired level. These types of orders are very important when you don't have enough time to look at the charts throughout the day and you want to open a trade at the desired level through your analysis. For example, let us say you did your analysis on ADA and found that $1 level would be a good buy for you. So if you don't have enough time to watch the price till it moves to your level, that is $1, so that you can enter a buy trade, what you can do is you can directly enter a buy limit and $1, and the trade will automatically open when the price reaches your desired level. So let us see how to use a buy and sell limit on the Binance trading platform. To open a limit order on the Binance futures trading platform, in the type of orders, select limit order. Now choose the currency pair on which you want to place a limit order. After choosing the currency pair, here enter the price at which you want to place a buy or a sell order. Here enter the amount you want to buy or sell. Now if you want to use take profit and stop loss orders along with this, take this box over here and enter the price over here. Now in the time in force section, GTC means good till cancelled. So select GTC if you want the order to stay intact till you delete it in future. IOC means immediate or cancel. So if you select this, the order will be filled immediately and any unfinished order will be cancelled. Now FOK means fill or kill, and here the order will get filled immediately, and if not, then it will not get executed at all. Now after you have done choosing, click on buy if you want to buy or click on sell if you want to sell. Your order will be placed and it will be visible on the chart as well as in the open order section. Now as soon as the price reaches the level at which your order is placed, the trade will be opened and it will be visible in the position section. Now if you want to cancel the order, you can directly do it from the chart or from the open order section. In this video, we learned about the buy limit and the sell limit. Now in this video, I will tell you what is stop limit and how to use it on the Binance trading platform. A stop limit order is a conditional trade over a set time frame with stop price and limit price features. A stop limit order will be executed at a specified price after a given stop price has been reached. Once the stop price is reached, the stop limit order becomes a limit order to buy or sell at the limit price or better. Let us try to understand this. In a stop limit order, you give instruction to your broker that when the price reaches a certain level, that is the stop price, a new limit order should be opened at your desired level. So first, the price reaches the stop price levels, which triggers a limit order, and then when the price reaches the limit order, your trade is opened. For example, let us say you are a breakout trader and on ADA USDT, the price is approaching a support zone. So what you want to do is you want to wait for the price to break the support and then enter at the retest of the support, which will now act as a resistance. So for this, you can use a stop limit. So all you have to do is select a price where you think the breakout will get confirmed. So let this be 0.94 level. So this will be the stop price. Now select a price where you want your trade to be opened. Let's say after the breakout, you think that the price will retest till $1. So you want the trade to open at $1 level. So let $1 be the limit price. In this case, sell limit. So when the price will break through the support and hit your stop price, a limit order will be opened, and when the price retests the level and touches your limit order, a sell trade will be opened. These types of orders are very important when you want to limit the emotions from your trading and strictly enter at the retest of an area. So let us see how to use the stop limit on the Binance trading platform. To open a limit order on the Binance futures trading platform, in the type of orders, select the stop limit. Now choose the currency pair on which you want to place a stop limit order. After choosing the currency pair, here enter the stop price where you think that the breakout will be confirmed. Like in our case, the stop price will be 0.945. Now here enter the price at which you want to open a sell trade. In our case, it will be at $1. Enter the amount you want to buy or sell. Now note that you always have to keep the trigger price to the mark price. Now in the time in force section, GTC means good till cancelled. So select GTC if you want the order to stay intact till you delete it. IOC means immediate or cancel. So if you select, the order will be filled immediately and any unfinished order will be cancelled. Now FOK means fill or kill. And here the order will get filled immediately. If not, then it will not get executed at all. Now after you have done choosing, click on buy if you want to buy or click on sell if you want to sell. In our case, we are going to sell it. So click on sell and your order will be placed and it will be visible on the chart as well as the open order section. Now as soon as the price reaches the level at which your stop order is placed, the limit order will be opened at your mentioned level, which is $1. Now, as soon as the price reaches the level at which your stop order is placed, the limit order will be opened at your mentioned level, which is $1. And when the price reaches $1 after this, your position will be opened. Now, you might be thinking, if the price doesn't break out and doesn't reach the stop price level, then what will happen? Your order will remain intact, but no position will be opened. Now, if you want to cancel the order, you can directly do it from the chart or from the open order section. Now, those who use Binance on their smartphones, to place a stop limit order, in the type of orders, select stop limit. Now, choose the currency pair on which you want to place a stop limit order. After choosing the currency pair, here enter the stop price and then enter the limit price where you want to open your trade. After that, select the amount of which you want to buy ADA or sell ADA. Then select the time in force, that is GTC or whatever you want to, and then click on buy or sell. So that is how you open a stop limit in the Binance trading platform. Thank you so much. See you in the next video.
So there is this amazing tool that the Binance futures trading platform offer, and it has helped me and made my trading a lot easier. Now, I am referring to the Binance trading calculator, and in this video, I'm going to tell you about the Binance trading calculator and how to use it with a lot of examples. So make sure you watch this video all the way to the end. Now, without wasting any time, let's get started with this. So this is the Binance futures trading platform, and to the right over here, this is from where we can access the Binance futures calculator. So if you click on this, you will see that there are 5 different sections. The first one is P&L, that means profit and loss. The second one is the target price. The third one is the liquidation price. The fourth one is max open, and the fifth one is the open price. Now let us understand each one step by step. So the first one is P&L, which means profit and loss. Now this is from where you can adjust the average, and this tool or this section helps you find out how much profit or loss will you have on an entry which you're about to take or which you have already entered. So for that, first you have to adjust the leverage from here, and then over here you have to put the entry price, then the exit price, and then the quantity of the currency you are buying or selling. So let us say I'm going long, and then my leverage is at 20x, and my entry price is, let us say, $3 per ADA, and my exit price will be, let us say, $4 per ADA, and the quantity I'm buying is 10,000 ADA. So when the price of ADA reaches to $4, you can see that I will have a P&L of 10,000 US dollars, and my return on equity will be 666.67%, and the initial margin required will be 1500 USDT. Now let us say that I entered at $3 and then the price moved to $2, and in this case again I bought 10,000 ADA. So in this case I will have a loss of $10,000, and the initial margin required to place this trade will be 1500 USDT, and the return on equity will be minus 666.67%. Now then up next is target price.
Now, this is an interesting section over here, and they have given it to help you know what is the target price you will require to achieve a certain return on your equity. So for that, here you have to adjust the leverage. From here, you will have to just adjust, like if you are going long, then select long, then, and if you are going short, then select short. Now let's say I'm going long on this pair and my leverage is 20x again. Now the entry price is $2.96, and I want to achieve, let's say, 5% of my equity. So when the trade reaches to 2.96740, then I will have achieved 5% return on my equity. Now up next is the liquidation price. Now this is again very useful tool, and this helps us to know when will our account get liquidated, that is at what price. So here there are two interesting sections. The first one is the cross and isolated margin, and you will have to select this as per your need. And then the other one is one-way mode and the hedge mode. Now for those who don't know what one-way mode and hedge mode is, these are the type of trading system that futures trading platform offer. In one-way mode, what you can do is you can only enter one single trade, that is buy or a sell trade. That is, you can either buy or you can either sell on a single currency pair. Like let us say if I open a buy trade at ADA, with that is I bought 10,000 ADA, and at the same time I want to sell 10,000 ADA, I cannot do that using the one-way mode. For that I will have to use hedge mode. In hedge mode I can buy and sell on a same currency pair at the same time whenever I want to. Now let's say I'm using one-way mode. Now to find out what is the liquidation price, that is, let us say I enter ADA at 3 and the quantity I'm buying is 25,000 ADA, and my account balance, as you can see, is 30,270 US dollars. So when I click on calculate, here they provide us with a liquidation price, and here it is 1.80583. That is when the price reaches that is when the price of ADA reaches to 1.80583, my account will get liquidated. Now up next is max open, which tells us what is the maximum amount of a currency you can buy. Now we are on ADA USDT, so, and our leverage is 20x. My account balance is 30,000 US dollars, and the entry price, let us say, is last price, which is 2.96200. When I click on calculate, you can see that the maximum ADA that I can buy is 84,402 ADA. Now, up next is open price. Now, this is again an interesting one, and I use this tool, this section specially, a lot. Now, the reason why I use is, what I do is I don't enter all my position at a single level. I keep on buying it at different levels, and then I get a good average price. So using this tool, what you can do is you can add, let us say I took four different trades on ADA. Let us say first I bought at $2 and I bought 5,000 ADA, and then I bought at 2.20 US dollars and then I bought 5,000 ADA again. Then I bought at 3, which I bought again 5,000, and then again I bought at that's at $2.50, and this time I bought 7,500 ADA. So when I click on calculate, they will give me a average price, which in this case is $2.43. So this will let me know that when the price reaches to 2.43, that is $2.43, I can still close my trade in break even, and it will also help me to keep my profits and losses in check. So this is how you use the Binance trading calculator. I hope you enjoyed this video. See you in the next one.
Hello, what's up everyone? I hope you are doing well. My name is Daksh and I welcome you to Crypto Trading Masterclass. Now, in this video, I'm going to tell you about a few tools that you will need in the strategy, and also how to read the chart so that you can use the strategy properly. So let us get started with this. The first thing that you will have to do is use the trading view chart from here. And then after that, you will have to add a technical indicator called as relative strength index, or RSI. Just click on it and then it will be added to your chart like this. After that, after you have done with this, there are a few tools that you will need when I will teach you the strategy. And for that, what you have to do is you just need to go to the tool that you will need from this toolbar over here, and then Inside it, go to the tool and then select the star button in front of it. Like let us say I need trend line, I need a horizontal ray, a horizontal line, and then I will need these tools, that is long and short, and then I will also need a rectangle. So I will just click on the star button over here, and then these all tools will be added to my favorite toolbar, like over here, right? So this is the first thing that you have to do, and if you want to hide it, you can just do it from here. Just click on the star and it will be hidden, and if you click on it again, it will appear on the screen. Now the next thing is to read the chart. So there are two important things that you have to know. The first one is the time frame. Like if you go to 1 day time frame here, it means that one candle will be equal to 1 day. That is, one candle will take 1 day to finish. If you go to 4 hour, then it will take, one candle will take 4 hours to finish. If you go to 1 hour, then it will take 1 hour to finish. Now let us understand a candlestick properly. So if you can see on the screen over here, a red candlestick tells us that the price is moving down. A green candlestick tells us that the price is moving up. Right? Now a candlestick has two parts. The first one is the wick and the second one is the body. Like let me give you an example. Like if you see this candlestick over here, right? There is a solid body which is of red color, and then there is a small thin line, right, on both sides of it. This is the wick. It means that when a candle was formed, this was the highest point till which it moved, and this was the lowest point till which it moved. Like whenever a bearish candle is formed, that is a red candle, it will move down, right? So when it moved down, before it moved up till this level, so this was the highest point till which it moved and so created a wick. But as it was started from here, it will just act as a wick, and then it moved down till this part. So this is the lowest point till which it moved, and it got finished till here. Like the candle completed till this point. So a candle has two parts. The first one is body and the second one is wick. Right? So there are two different kinds of candles. The first one is a bullish candle, and then there is a bearish candle. The green one is the bullish candle and the red one is the bearish candle. So apart from this, you will also need this tool that is called as measure. With help of that, you can measure your stop loss and take profit. So what you have to do is just click on this tool. Now let us say that you want to measure how much percentage is the move from this point to this point. So you will just click here and then move till that point. So which is equal to 2.91%. So this is a tool that helps you in measuring the growth so that you are able to place your stop loss and take profit perfectly. Like let me give you an example. Let us say that I entered a sell trade here and I want to keep my stop loss 2% above it, right? So I will measure 2%, which will be till this level, right? And my take profit, let us say, let us mark it with this. So this is my stop loss, and let us say I want a take profit of 10%. So it will be till this level, right? Which will be till this level. So this tool is very helpful when you you want to measure the move of the market. So that's it. These are the few important things that you will need throughout the strategy. See you in the next video. Hello, what's up everyone? My name is Daksh and welcome to Crypto Trading Masterclass. I hope each one of you is healthy and doing just fine in the markets. Now, till now we have learned everything, every basic thing that you will need to trade in the crypto markets. Like you know from where to open the account, how the markets work, what is the funding rate, what is leverage, and different other things. Now we are here to the most important part of this masterclass, and that thing is the strategy. Like which strategy are we going to use to benefit from the crypto markets? Right? We need a strategy to trade in the market. We cannot directly go and do whatever we want. We cannot just buy and sell wherever we want. We need to have a specific strategy for each kind of market. So to understand the strategy, first you will need to understand the type of market we are dealing with, right? Because the crypto market is totally different from any other market in the financial world. Let it be stocks, let it be Forex, commodities, or any other market. Crypto market is totally different. So before I move on to the strategy, before I teach you different strategies, because I'm going to teach you 2 to 3 different strategies in this masterclass, which will be very helpful for you to trade. So before we move to that part, first I want you to understand how the market works, because this is going to be the foundation of those strategy that you are going to learn. Let us first understand how the market works, and then we will move to the strategy parts from the next videos. And I don't want you to skip this part, because this is going to be very, very important. So make sure you pay attention, take notes if you want to, and enjoy the video. As I told you before, the crypto market is totally different from any other kind of market. And the reason is how the crypto market moves. The crypto market moves, it will just go boom like this, and it can go bust just like that. So what the crypto market does usually is it moves up, it gives 100-200% move, then it moves this sideways, then it again moves up, right? It moves up, it moves sideways, then it again moves up. And the growth here, the move here are not of 5 to 10% like any other market. Here, the moves are actually of 100-200% or even 1000% if you are lucky enough. This is how the crypto market moves. But not only this, also what happens is the market can move like this, it can range like this, and it can again move like this, then it can again bust like this. The market either can trend up, the market can move sideways, or the market can trend down. There will be a different strategy for a trending market, let it be uptrending market or a downtrending market. There is going to be a different strategy for this. Also, there will be a different strategy for a ranging market, and then there will be a different strategy for reversal entries. Now, what is reversal entry? It is to find out when a trend is going to begin. Like, let us say if the price is moving up like this, right? So it will not continue to always move up. At some point, it is going to drop down. So how to identify that some point from where the price is going to drop down, or how to identify some point from where the price is going to move up? This is called as a reversal entry, which we are also going to learn in this masterclass. In this masterclass, I'm going to teach you how to trade the trending markets, how to trade the ranging markets, and also how to find out reversal entries, which is very, very important if you want to earn those big bucks. I think that's it for this video. In the next video, we will begin by understanding how should we trade trending markets. I will see you in the next video. Hi everyone, what's up? I hope you are doing well. My name is Daksh and I welcome you to Crypto Trading Masterclass. In the previous video, I told you about the different kind of markets and how does the market actually work. I also told you that I'm going to teach you different strategies for different types of market, like a strategy for a trending market, a strategy for a ranging market, and also a strategy for reversal trading. So in this video, I'm going to teach you about how to trade trending markets. So before we move to that, I want to give you a basic concept of what is a trending market and how do you actually find a trending market, and then we will move on to how should you trade trending markets. So let us go to the chart and understand what is a trending market and how to find one. There are two different types of trending market. The first one is in which the market moves up and it is called as an uptrending market, and then there is another one which is called as a downtrending market, and in this the market moves down. Whenever this happens, like whenever a market is trending, it won't move in a straight line like I just draw. Okay, it will always move in a form or a pattern, and that pattern is called as highs and lows. Like the market will move up like this, then it will move down, it will move up, move down, move up, and move down, and again move up. In an uptrending market, what the market does is it will first move up, it will create a high, then a low. Then after that, when the market moves above it, that will be our higher high. And when then the market moves down and stays above this low, then we will get a new low, which will be called as an higher low. After that, the market will again move up, it will give us an higher high. Then again, if the market moves down and stays above this low, this will be our high low. This is how a market will move in an uptrending market in a pattern of higher highs and high lows. Right, now the next type is downtrending market. In the downtrending market, just opposite of this happens. Like the price will first create a low, then it will move up and it will create a lower high. Then it will again move down, it will create a lower low, because this time this low is lower than the previous low. That if the market moves up and stays below this high, then this will be our lower high. And when the market again moves down and moves below this, this will be our lower low. So this is how a market will move, and this is how you have to find if a market is uptrending or downtrending. Now there is a very important thing which you need to understand. We will not need this in any of our strategy, but this is important, so I want to tell you about this. Whenever a market is moving up or down, let us say it is moving up, it will move in a form of highs and lows, right? Higher highs and higher lows. That is higher high, higher low, higher high, higher low, higher high, higher low. But it won't always move, like it won't always continue to move up. At some time in the future, it will have to move down, right? So how do you know if the market has changed its trend? We get to know that when the price moves down again to create, let us say, a high low, because this low is higher than this one. But then when it goes to make a new high, it fails and drops below this high low. This new low will not be higher than this, and hence it will be a lower low. This is called as a momentum change, and this tells us that the market is now changing its trend. Like this was an uptrending market where the price was creating higher highs and higher lows. Then it failed to create a higher high and created a lower low instead. So we are now in a downtrend and the market can move like this. This is how you understand if a market is in an uptrend or a downtrend. Now let us take an example to understand this. Let us say we are on a 1 hour chart. If you see this example, this is a perfect example of an uptrending market, right? Let us say this was our final low, right? The market was downtrending over here. This was our lower low. After this, you can see here, over here, price created a lower high. Then it again moved down, but it failed. It failed to create a new lower low, right? This was the lower low, but it failed to move below this. And instead, what we have seen, what we have got, what the price have done is it created an higher high, indicating that there is a momentum change. So this is how you observe the momentum change. And after that, you can see the price created a low. Now this low is higher than the previous low, so higher low. Then again the price moved up, then higher high. Why? Because this high is now higher than this high. Then a higher low, a higher high, higher low, higher high, higher low. Then again a higher high. Then again a higher low. Now the price has to move below this if the price has to change the trend, right? So let us observe and see what happened. Here you can see the price created a new higher high, right? The price created a new higher high, but then it again failed to create a new higher high. Then the price moved down, and then we are now seeing a downtrend. The price is moving down and creating lower low, lower high, lower low, lower high, and lower low. This is how you identify a trend. The next thing is, how should you trade the trending market? Now, basically, there are two ways which I'm going to teach you even in this. The first one is by using the moving averages. Let me first clear up the charts and we will begin with that. Okay, so the moving average which you are going to need is moving average 7, that is 7 period, then 25, and then 99. And these all will be by default on your Binance chart. Just go to Binance chart and then go to trading view chart. There you will see different indicators. If there is not an indicator installed in your chart, what you can do is you can go over here on the technical indicator option and then search for moving average and then add all the periods over here. After you have identified what the market type is, what you have to do is you have to use moving averages on the small time frames. Like moving averages will be mostly used for day trading or even scalping, which will be from 3 minutes to 5 minutes or max to max 15 minutes of time frame. So let's go to a 3-minute time frame and see how to trade using the moving averages. Here we are on BTC USDT 3 minutes chart. You can see this moving average, which is the yellow line. And here, first what you have to do is you have to find the market, right? It was uptrending here, then it was downtrending. When we saw that the market is downtrending now, what you have to do is you have to wait for the price to respect this moving average. And what does respect mean? Respect means that the price will move to it and drop down, move to it and drop down, move to it and drop down. So when you see that this thing is happening, what you have to do, just let the price move towards this moving average. That is the yellow line, which will be the 7-period moving average. And then you have to enter a sell trade if the market is moving down a buy trade if the market is moving up. So in our case, we got to know that the market is moving down, and then the market started to respect this moving average. So what I will do is I will enter a sell trade over here. I will keep my stop loss always above this pink line or violet line, and my take profit will be below this. Then again, it touched over here, and then it moved down. I will enter here. I will take my take profit will be over here. Then again the same thing happened. Price moved down sharply. It bounced back. It tested this. It again moved down. So I will enter here. I will exit here. So this is how scalping works. In scalping, what you have to do is you will have to enter and just get out within a few minutes. That's how scalping actually works. Okay, yeah. One more thing I forgot to tell you is once you see that the market is moving down and it is following the moving average, but at times what will happen is it will stop. It will take your stop loss. Like let us say till this point, your trades work out just fine. But then over here, you can see the price actually moved above this, and then it did not drop below this, and it moved above this line, which is the violet or the pink line. And then you got to know that yes, now you have to stay calm. You have to stay very patient and wait for the price to again move down. Because what happens when the price stops to respect this moving average, that is 7 period moving average, and moves above the 25 period moving average, then we get an indication that the market can now move sideways and correct a little bit, and then it can again move down. So you can see how the price then corrected and it again moved down. Whenever this happens, that the price moves above this line, that is the 25 period moving average, then you have to wait and let the price correct and then again start its trend down. Then we waited over here till this, and then when the price again started to move down, it respected this, moved down, respected this, moved down. So here you have to enter. When the price touches this line, your stop loss will be a few pips below, above this. Your take profit will be here. Like when this moving averages are too far apart, your stop loss will be a few percentage above this, and your take profit will be over here. Then the same thing happens. This is how you have to trade trending markets with the help of moving averages, and mostly you will have to scalp with this strategy. Now, how to trade trending market while you day trade, right? Which will give you higher take profits and a small stop loss. So let us see how to do that. And this will need the basics which I taught you just a while ago, that is about highs and lows. Moving forward, another way to trade trending markets is with the help of patterns. I have identified that a few patterns work very good with crypto trading, and I'm going to tell you which pattern are those, but let us first understand this. Like I told you, like if there is an uptrending market, the price will create highs, lows, highs, lows, highs, and lows. This low or retracement, which we call it, create a certain kind of pattern. And when this pattern is identified properly and traded, it gives us a very good win rate. There are two types of pattern which I want to tell you. The first one is a flag. A flag just looks like this. There will be a pole and then a flag-like structure like this. This will be a bullish flag, and then there is a bearish flag in which price moves down, creates a structure like this, and the price then moves down. And the second pattern is channel. Channel is when the price moves between these two lines like this. Like let us say the price first created an high, then the price will move between these two lines like this, and then it will move up. So this is a channel. Some people also call it a flag, but I'm distinguishing it just so that you understand it properly. And the other one is a range or a flag, and the other one is a flag. So let us see how to trade these two patterns. As you can see, the first step will always be the same. We have to identify the trend because we are trading the trending markets, right? The first thing which you have to be aware of is when the price moves down. Whenever you see such a price drop, such a violent price drop, you have to always wait, always stay patient, because it won't crash. It won't crash. It will never crash. It will always, after a strong move sideways. And this sideways move is which will help you with finding out a pattern. Like over here, just let me remove this first. Okay, like over here, you can see the price dropped down, then it created a range like structure, which can also be called as a flag. right? So this will be our pole, like the pole of flag, and this will be the body of flag. So price was moving down, it created a flag, and when it breaks out of this line, right, this horizontal line, you have to enter over here. When it breaks out of it and the candle finishes, you have to enter over here at the retest or over here, and your stop loss will be a few percentage above this, right? This will be a risky stop loss, and if you want to place a safe stop loss, then it will be above this body of flag. Like this was the first pattern, and the other pattern is channel. So whenever the price moves down sharply and corrects, it creates either a flag or a channel. Like in this case, you can see if we connect this first point, the low, and move it towards this. This will be our first point from where the price moved up, and it again came to this line, and it again moved up. So take this line, and then again, you can also just click on this and clone it, and then move it above and see if a channel is formed. So you can see some people also call this a flag, but let us keep it different. This is again a channel. The price breaks through it, and then the price moves down. So what you have to do here, you have to wait for the price to break out. Like you can see here how a candle is formed. So you have to wait for a candle to form below this line. Then you can enter over here. Your stop loss can be above this if you are experienced, because this will be a risky stop loss, because what price can do is price can just give a fake breakout and then move again over here and then move down, right? So a safe stop loss will always be above this, and your take profit will be till this level over here. And in this case, the same thing. Now let us take a couple of more examples. Here again, you can see, like I told you, the price when drops, it won't just keep moving down, it won't crash. So the same thing happened over here. So we will take a line and then draw it. This is again a flag. Price move down. You can either enter over here, keep your stop loss above this or above this, and take profit will be over here. So for take profit, what you can do, just measure this move like it is of 4%, and then after the breakout, measure 4%, exactly 4%. The price moved exactly 4%, and then it started to move up. I also want you to keep in mind that we are trading a trending markets, right? So in this case, whenever market is trending down or up, like in this case, the market is trending down. So we will always look for sell entry, and even if we find buy entries, we will not get into it unless and until we see a reversal. And I will tell you about reversal in a later videos, and when we combine all this, it will make much more sense to you. Now let us take a couple of more examples. Like here was a flag, but we have to ignore it, because in this case, if you see, we would have to enter a buy trade, but it is against our rule, so we will ignore it. Then again over here, you can enter after the breakout. Again over here, you can see how price created a channel like structure. It was moving in a channel, it broke out, and then it started to move down. Now even after this, it again gave us a nice little flag. It break below it, and then it moved down. This is how you trade trending markets. The first one was with the help of moving averages, and the second one is with the help of two patterns which are very repetitive in crypto industry or in crypto market. The first one is the flags, and the second one is channels. I hope you understood everything. If not, then let me know. I will be happy to help you. Thank you so much. See you in the next video. Hello everyone, what's up? I hope you are doing well. My name is Daksh, and I welcome you to Crypto Trading Masterclass. In the previous video, I told you what are trending markets and how to trade them. Now, in this video, what I'm going to be doing is I'm going to tell you what is a ranging market, what is the psychology of most of the traders during a ranging market, and how should you be trading a ranging market. Let us start by understanding what is a ranging market. Right. So if you can see on the chart, the price either moves up, and when it moves up, it is making a progress, right? Even if the price is moving down, it is even then making some sort of progress, maybe in negative, but it is. So a ranging market is something when the price doesn't make any progress. That is, it is just moving sideways and it is not making any progress. What it is doing is it is behaving like it is trapped between these two walls, and whenever it touches any of the wall, it bounces back. Like let us say these are the two walls. The price was first moving up, it moved at a point, and then it dropped down. Then it moved here, moved up, then it touched here, moved down. So what the price is doing is it is moving like it is trapped between these two walls. So what happens in a range is price behaves like it is stuck between a wall. So the level from where the price bounces back acts as a support, and the level from where the price drops down acts as a resistance. So resistance means that someone is selling, or the price is not able to move higher, and so price will drop from a resistance, and a support means that the price will move up. So resistance means it is an area for sellers to get in, and support means it is an area for buyers to get in. So whenever the price moves to a support, it moves up, and whenever the price moves to a resistance, it moves down. So in a range, what happens is the price is stuck between a resistance and a support, and it will just move like that. Now, the important thing to note is the price won't always move in a range, right? At some point in the future, it is going to break above or below it. What I mean to say is, if the price is moving in a range like this, it won't always move like this. At some point, it may break above it or it may break below it. So based on this, there are two different ways to trade ranging market. The first one is to trade a breakout of it, and the second one is just use the walls or the levels as resistance and support, and then get into a trade. So let me tell you how to do that. Let me first clean it. Like, let us say this was our resistance and this was our support, and then the price is moving between these two lines, right? So this is acting as a resistance and this is acting as a support. So the first way to trade it is using support and resistance. So let us say that you have two touch confirmation, that is first 1 and 2 and 2. After this two touch confirmation, what you can do is whenever the price drops or moves up, like let us say in this case the price moved up above here, and we already have two touch confirmation, that is 1 and 2. So the third time when the price comes near this, what you can do is you can enter a sell trade over here, keep your stop loss a few percentage above the zone, and your take profit should be a few pips or a few percentage above the support. Now when the price moves down, what you can do is buy here, keep your stop loss here, and then your take profit will be a few percentage below the zone. So many times what will happen is in a range, the price won't move perfectly like I have drawn. Sometimes it will just move up. Like let us say you entered over here, you entered a buy trade over here, and then the price moved up. It will just hover around here. So whenever you see things like this happening, it is better to close your trade, because what the price can do is price can then move down here and then break out and then move down. So it is always good to take your profit. So this was the first way to trade it, right? Now the second way is whenever the price breaks out of it, whenever a candle is formed outside of that, you have to enter over here and then keep your stop loss a good percentage below this candle, right? Below the start of that candle. Or what you can do is wait for the price to retest it and then enter a trade and then keep your stop loss over here. But what will happen in this is many a times this price will create a fake breakout. It will just take your stop loss, and it is very common in crypto, and then it will move up. So whenever you are trading a breakout of a range, it is better to keep your stop loss below this, right? If you are entering after this, it is better to keep it below this support. And if you are entering over here, like let us say you entered a sell trade after the breakout over here, then your stop loss should be over here, right? And if you are experienced enough, then you can keep it in between over here. If you are not, then it is better to keep it safer so that you don't get out of a winning trade. Now let us take some examples to understand this more clearly. So here we are on BTC US dollars 30 minutes chart. So the first thing that you have to do is whenever you find a range, take this horizontal line from the toolbox and then draw a support with it, and then also a resistance with it, right? Try to match as much points as possible. Like here we have more than two touches, so this line is better. So let us now say we have the first touch, then the price moved up, then a first touch, price moved down. So first touch to a support and first touch to a resistance. Then the price moved down till here, second touch, then the price moved up. It tried to break out of it, but then it created an order block and then it again moved down. So now we have two touches of each. So after we have two touches of each, when the price comes down over here, like let us say the price came near here, and then you will enter a trade over here. Your stop loss will be a few percentage below this. What you have to do is you have to aim for at least 1:2 risk to reward ratio. So let us say you entered over here, you kept your stop loss 2% below it, and your take profit will be around 2%, which will give you around 1:1 risk to reward ratio. Now again, you entered over here, your stop loss will be 1 to 2% above it. Like in this case, there's a zone here, so we will keep it above that. Like let us say 1% above it, and your take profit will be at this point somewhere near here, that is 1.84%. It is almost 1:1.89 risk to reward ratio. And then again over here, you will enter and you will close over here. Now again, there is a range type of structure over here. So the first thing you have to do is draw a line, right? So in this case, it will be something like this. Like first, we won't be having this zone, right? So the area will look something like this, because let us say we don't have this area when we were at this point of time. So we will just hide it. Now let us say we saw a range forming over here. So we got the first touch over here, then a first touch, a second touch, the price broke out of it, but then it moved back in. So it will still count as a second touch. Then it again moved up, then again it tried to move down, up, but then it moved down sharply. So now we have two touches each, right? So we will enter here, like let us say I entered my trade over here. My stop loss will be a few percentage below this, and my take profit will be above here, right? Then again at the third touch, let's say I entered at this touch, my stop loss will be above this line over here, and my take profit will be around here. It is almost giving me 1:3 risk to reward ratio. So this is how you trade ranges using support and resistance. Now let us see how to trade it using a breakout. So in that case, let us say we have a range over here. So you can see how when the price broke above it and a candle is formed above it, right? We will enter over here. As I told you before, that if you keep your stop loss over here, what price can do is it can just move down over here and then it can broke out above it. So it can take your stop loss. So it is always better to keep it below this, right? Like let us say this was a range over here, and you can see how the price broke out of it, and then but it come down and down and down, and then it moved up. So eventually your trade was right, but if you would have kept your stop loss in between over here, it would have take your stop loss, like stopped you out, and then it would have moved up, right? So it is always advisable to keep your stop loss below the support if you're entering a buy trade after the resistance is breached. Let us say in this case, okay, we got to know that the price is ranging after there were two touches, right? So we decided to enter after the price broke below it or moved below it over here, right? This was our range, it moved below it, and if we would have kept your stop loss again over here, it would have stopped you out, and then you can see how it moved down, right? So it is always advisable to keep over here. This is how you trade ranging markets. Now in the next video, I'm going to tell you how to look for reversal entries. So see you in that video. Hello everyone, what's up? I hope you are doing well. My name is Daksh and I welcome you to Crypto Trading Masterclass. Now, in the previous video, we learned how to trade a ranging market, right? Like what is a ranging market and how do we need to trade it? But now in this video, we are going to learn something very exciting and something very important, which is how to trade the reversals. Like how do you find a reversal in crypto market? Before we move forward, you need to first understand two very important things about reversal entries. Okay, so the first thing is whenever you find any reversal entries, what you are doing is you are going against the trend. Like if the market is uptrending and you are finding a reversal entry, that means that in a market where buyers are more or the buyers are in control, what you are looking for is a sell entry. That means you are going against the market. That is, in an uptrending market, you are looking for a sell entry, and in a downtrending market, what you are doing is you are looking for a buy entry, which is going against the market. So you need to understand that whenever you are planning to take a reversal entry, you are going against the market. So the second most important thing which I wanted to tell you is, whenever you find a reversal entry, you need to have two very important things with you. The first one is an important area, and the second one is a momentum change, right? Previously, when we traded the trending markets, we already had momentum with us. Why? Because the price was moving up and we were taking all the trades with the market. That is, if the market is moving up, we used to take only buy trades, and if the market is moving down, we used to take only sell trades. So we had an important area and the momentum was already with us, right? But here, what we are doing is we are planning a reversal entry, right? So we may have a support area or a resistance area in this case, right? But we don't have something that will tell us if the momentum is changing from buyers to sellers, right? So while planning a reversal entry, you need an important area, plus you need something that tells you that the momentum has changed. So there are two different ways to trade reversal entries. So the first way is with the help of reversal patterns. Like when I told you how to trade the trending markets, there were a few patterns, right? In the same way, there are some patterns that tells us that there is going to be a reversal in the market. So let us learn about those. So the first pattern is a double top or a double bottom, right? So let us first understand this. Like whenever the market is moving up or it is uptrending, there comes a point when the market moves down, then again moves till the same point, and then it drops down, right? So this is called as a double top. Now when the same thing happens in a downtrend, that is whenever the price is moving down, it reaches a point from where it bounces back, then it again moves down till that level, and then it again moves up, and now this time it moves above this point, right? In this and the same thing happened over here. So this is called a double top and double bottom. Now let us understand why this is important and how does this tell us that there is a momentum change. Like when I first told you about the highs and lows, when we were learning about the trending markets, I told you about the highs and lows, and if you can recall, I also told you that there is something that highs and lows tells us about the momentum change. That is, whenever the price is moving up in an uptrend, it will create high high, high low, high high, high low, high high, high low, and high high. But when it is not able to create a new higher high and creates a lower low instead, that tells us that there is a momentum change. So in double top, the same thing happens. That is, in double top or double bottom, the same thing happens, and that tells us that there is a momentum change. Like let us say this was a higher high, and then this was the higher low, then the higher high, higher low, higher high, higher low, but the price then failed to create a new higher high, right? It failed to move above, and it created a low which was lower than the previous higher low. So this would be our lower low, right? So this is called a double top. So whenever you find a pattern like this tells us that the trend is now going to change, and now you can look for a sell entry, right? And the same thing happens with double bottom. So let us understand how to trade double tops. So let us say this was the market which was moving up, and then it formed a double top, right? Now from here you got to know that the price is now moving down. So you have to first wait for the price to move above this and create a lower low, right? This is also called the neckline of double top, and there are many different names to it. Okay, but let us understand the concept behind it, like why it is important. It is not just a pattern, there is a psychology, there is something that tells us more why it is important. With the help of highs and lows, we got to know that there is a lower low now. So whenever the price retests it, that is when you enter a sell trade. Like whenever there is a double top, you look for a sell entry. So let us say the price broke out of it and then it retested it. This is where you enter. Or you can also enter when the price goes below this line, a candle finishes below this. This tells us a new lower low is formed. So you enter at that lower low, and your stop loss will always be above this, no matter what. Okay, so this was the first way to trade it. And the same goes with a double bottom. Like let us say this is a double bottom, then the price moves up above this, it creates a high, right? The price was initially creating lower low, lower highs. it did the same till this point, but it was not able to create a new lower low and instead created a higher high. Why? Because now the price moved above this lower high, so it created a new higher high, and therefore telling us that there is a momentum shift in the market. That is, the seller are now out of the market and the buyers are in, and now the price can move up, right? So you enter after the price moves above this high, that is lower high, and creates a higher high. Whenever that candle is finished, that is the point where you enter, and your stop loss will always be below this in a double bottom and above that in a double top. Let us take an example and see how to trade tops and bottoms in the market. If you can see over here, the price was downtrending. That is, it was creating a lower low, lower high, lower low, lower high, lower low, lower high, and lower low, right? But at this point, if you can see, something changed over here. That is, the price moved up, but this time it created a bottom with the same level, but it was not able to go below it and continue that streak of lower low and lower high. So instead of that, it created a high which was higher than the previous low high and hence a higher high. So this was our double bottom, and when the price moved above, it indicated that the momentum has shifted from sellers to buyers. So when this happened, you can enter your trade after the price move above it and created a higher high. So you can enter here and your stop loss should be at this point. And about take profit, what you can do is whenever you enter over here, you have to at least aim for a risk to reward ratio of 1 to 2. That is, if you are risking over 12% over here, then you should get at least 24%. Like your take profit should be around here 25%, that is 15.57 level. That is the level of 76.96. So this is how you set a take profit. So in this case, if you enter a buy trade, let us say you enter a buy trade over here, just take this tool, that is long and short tool, and then keep your stop loss below here, and your take profit should be to a level where you get at least risk to reward ratio of 1 to 2. Like here you can see this is the risk to reward ratio you will get on this trade. So you can see how the price then retested it, and then it started to move up, and it moved up till this level. One more thing that I would like to tell you is what most of the traders, like I have seen many traders doing this mistake. What they do is, let us say that the price is moving up over here, right? It moved up, and at this point the price dropped sharply. Like this is a good considerable amount of move. So what they do is, when the price moves above till this level, they consider this a double top, and they will just enter right over here. They don't wait for the momentum change, which I told you should wait. And so then the price moves up, it then plays with the emotions, and they get out of the trade. So what you have to do instead of that is, whenever you see a double top, you have to wait for the momentum change. That is, whenever the price moves below it like it did over here, that is when you enter. When the price breaches this level and creates a lower low, like here higher high, higher low, like it was an uptrending market, so the price was like, it was an uptrending market, so the price was creating higher highs and high lows, higher high, higher low, and then a final higher high, which is a kind of a double top, and then the price moved down, then created a lower low, right? So this is how you trade a double top. In this case, you will select this tool, that is short position. Let us say you entered when the price breached this line, let us say over here, your stop loss will be above this, and your take profit will be such that you get at least 1 to 2. You should get at least a risk to reward of 1 to 2 till this point. Okay, so this is how you trade double top. There is another way to find out reversal entries and trade them, and that is one of my favorite way. So let us learn about that. So in this way, what we do is, we need two different things, right? The first one is an important area, which could be a resistance and a support, and then you need to have a momentum change. So instead of the regular way of finding the momentum change through highs and lows technique, what we do over here is, we use a momentum indicator. Like RSI is kind of a momentum indicator, and what happens in this indicator is, I will just give you a brief of it. Like, this is the RSI indicator. It has two levels, 70 and 30. 70 indicates that the price is overbought, and whenever this line, the RSI line, touches it, price moves down. And the 30 level indicates that the price is oversold, that is, the sellers are getting exhausted, and whenever the price touches this line, the price moves up. Okay, so this is the concept of RSI. So what we do is, we use this indicator to find a momentum change, and then we use support and resistance to find an important area, and then we combine both of those, and then we find entries on it. Now, to take it a level higher, what we do is, we use a technique called as divergence. So let us first learn what is a divergence. The role of RSI is to follow the price. And what I mean is, let us say that if the price is moving up like this, the RSI will exactly follow the price like that, and it will indicate us between these two levels of overbought and oversold, right? So let us say if the price is creating higher highs, the RSI will also do the same. But in case of divergence, what happens is, the price is creating a higher high, but the RSI quickly moves to overbought level and then creates a lower high instead. That is, it goes against the price, and this tells us that there is something wrong in the market, or there is a momentum shift in the market, and this is what we call as a divergence, which gives us a very good signal of a momentum change. And when this thing is formed at a resistance or support, we have an important area, plus we have something that signals us about momentum change. So let us understand this more clearly and step by step, so that things are very, very clear to you. So let us say that this is the resistance, right? The price first moved to this level and then it dropped from it. Now again, the price is moving up, creating higher highs and higher lows. It moved till this level, right? And it created a higher high over here. This is the final higher high. So what the price did, so what the RSI did is, it was first creating higher highs just like the price was, but then it moved up. So when during this touch, it create a high, but then it create a lower high. So this was the final higher high in the price, in the actual price, but the RSI moved against it, right? The RSI is not agreeing with the price, telling us that there is a momentum change. So now we have a momentum change, which is the divergence, and we also have an important area. So in this case, what we do is, we enter a sell trade over here, keep our stop loss a few percentage above the zone, and our take profit will be till this level. Or you can also follow the rule of getting at least 1 to 2 risk to reward ratio. Now, let us take a few examples of this to understand it more properly. Here we are on ADA USDT 4-hour chart. So the first thing that we have to do is, we have to find an important area. So if you just look at this pair over here, you can see how the price has tested this zone a lot of times, right? Like, it first moved up, moved down till this level, it moved up, moved down till this level, then again moved up, then again moved down till this level, and it again moved up. We have an idea that this is some kind of an support. So what we'll do is, we will take this tool from here, rectangle, and then we will just draw a support zone. We won't draw a line, but we will draw a zone, right? So let us say we are taking all the wicks, and then we are drawing a zone. So this was our support area. After this, what you have to do is, you now have a important area, right? You have an important area, and you have to look for a momentum change. So if you look, the price was here creating lower lows, right? Lower low, lower high, lower low, lower high, and lower low. But if you mark it, this is a lower low, but if you go on the RSI and mark this level, you will see that the price has created a higher low instead, right? This was a lower low, but the price has created higher low, telling us that there is something wrong in the market. So after this, we enter a buy trade over here. When the candle is formed, our stop loss will be a few percentage below this, and our take profit will be at least till this level, right? So you can see how we are getting a risk to reward ratio of around 5.93. That is, if you are risking $10 in it, or let us say you are risking $100, then you are getting a reward of $600 or $590 in a single trade. So this is how you enter a reversal entry with the help of this technique. I hope that you now know how to find out reversal entries and how to trade them efficiently. And I've also told you two different ways to do that. Now in the next video, I'm going to tell you about risk management, which is one of the most important thing in any kind of trading. So see you in that video.